This presentation contains the current views and opinions of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.
Hello, everyone, and welcome to the Compact Market Wrap Weekly Update for June the 1st, 2026. I'm Moe Ansari, President of Compact Asset Management, joined by Javaid Ansari, Executive Vice President at Compact. Thank you for joining us today. First of all, quick reminder, just click on the subscribe button, and whenever we post an update, you'll be notified. Also, you can go to compact.com, click on Insights, and you can get all the charts that I'm talking about. If you need help with your portfolio, need a second opinion on your assets, give us a call at 800-388-9700, or you can just send us an email at compact.com. Another housekeeping note, the book is coming out. Feroz Ansari, as you know, he's my younger brother. He's worked with me for the last nearly 25 years. He's also an adjunct professor at UCI, where he teaches finance, but his book, Wisdom and Wealth Solutions, coming out. You can go to wisdomandwealthsolutions.com and order the book, or just go to Amazon and you can pre-order it also. Let's start with the numbers, Javaid. What do you think?
Well, markets are great last week. Once again, S&P up 1.44, Dow up 0.91, Russell up 1.77. IFA, it's been lagging a little bit, only up 1%, so it's still up.
Well, the emerging markets did well.
Yeah, emerging markets up 3.97, up 4%, and NASDAQ up 2.4. You know, you look at emerging markets, I look at it in many ways, it's very similar to just plain DRAM. When you look at some of the big holders of the biggest components of the emerging market index, it's Taiwan Semiconductor, SK Hynix, and Samsung. And so basically what we've seen so far for the first 5 months, and particularly in the month of May, has just been a huge tech rally, and it's taking everything up with it. Markets are kind of still going up. S&P is only up 11%. I want to say only. Is up 11.27%. NASDAQ's now up 16%. But I think what makes it more spectacular is that you look at these 3-year returns, we're up almost 87% on the S&P over the last 3 years. NASDAQ's up 112% over the last 12 years. So given the reset we had in 2022, it's been an incredible run. And you know, the AI infrastructure and play is really driving the entire stock market, even though we're seeing headwinds a little bit on interest rates, seeing headwinds from the situation in Iran didn't seem to get better over the weekend. And so that's kind of hurting majority of the stocks. But because these tech stocks, these AI stocks are going up at just kind of almost mind-boggling rates, that's what's pulling up the entire indices going
And it's
forward.
not just it was the AI. Everybody's saying, okay, now it's the people who are supplying the stuff for the AI.
Correct. So originally it was the Magnificent Seven. Those are the ones that are creating the AI, and we'll have some new, I don't know if they're going to be quite magnificent, but we'll see once they IPO, but we'll have some new large companies as part of the S&P and NASDAQ here. Anthropic, I think, just said that they were going to potentially do their IPO. I know there's a lot of interest around SpaceX, which is not so much AI. It has XAI, but it's not, the big leaders in AI are basically Anthropic and OpenAI and Google. I would say those are the main three kind of players right now in terms of the algorithms. And so we'll just see. We'll see how these things, how they IPO. The whole story is, we're going to have this build out. You look at all of the memory chips, they're sold out for this year. And potentially they're moving. I think when you talk about semiconductors, traditionally these are the components, right, that of course go into all these data centers. Traditionally, when you talk about semiconductors, you worry about the boom and the bust.
They
right?
go through cycles.
They go through cycles. They ramp up production, and then the demand isn't quite there, and it falls off a cliff. I think what's a little different this time, which is I think reassuring, is that a lot of those contracts for semiconductors, from the suppliers to the data centers, those were all 1-year contracts. Now they're signing multi-year contracts, which is great, I think, for the chip components, right? Or for if you're making chips because you have a contract, but we're getting further and further out to making even longer term commitments on what is traditionally a very fast moving type of sector. And so, nothing tells us to kind of question it. But when you see things move this quickly, in such a short amount of time, just know it can also move the other direction just
When
as quickly.
markets go parabolic, they go straight up, but they also come straight down. That's the problem with something like this. But at this point, you've got to enjoy it, enjoy the ride, and not get unbalanced. That's what happens to too many people. I'm going back 25 years where everybody wanted a .com. Everybody just said, "Oh, I've got to have .com, whatever it is, buy .com, whatever .com it was. They had to have .com, and they got too unbalanced in their portfolios. When the market came down in 2000, when the internet bubble burst, it took the whole portfolio with it, and that's what people have to be very, very cognizant about right now. Is make sure that you don't get sucked into this. Make sure you have it, but make sure you don't overdo it. And that's where it's greed and fear that drives these markets. And when greed gets in the way, it's a problem. Or when you get too fearful, it's a problem. And that's what you have to keep balanced with.
And I tell people, if you want to participate in SpaceX, if you want to participate in DRAM and all of this stuff, sure, go buy a little bit, but figure out ultimately how much of your portfolio you're going to put into it. It's the position size within your portfolio that you really just need to be cognizant of. If you're fortunate enough to have a lot of your portfolio in these stocks, well, then that's great. Now might be a time to then go the other direction where you're looking to diversify it. So if you would like me personally to review that with you and walk you through it and give you some suggestions, just shoot us an email at invest@compact.com. or give us a call at 800-388-9700. I'd be happy to give you a look and just give you our professional second opinion.
Technology was the big gainer. It was not doing well the week before, but last week it did well, up 4.6%. Energy was the worst. Today, energy was the best because last week there was a big indication on Friday that the Iran deal would get done, or at least a memorandum would get signed. That's what the market was all excited about. Oil prices are below $90 a barrel. Today, they're saying, nope, nothing doing. Iran says, we're not talking anymore. The president said, I've sent new demands to Iran. So we're back, and they're starting to shoot at each other, just a little skirmish here and there. So we're back to that. So it's just one day you've got the war is over, next day the war is back. So that's what's driving a lot of this, especially in the energy
And we'll look at the DBO chart. Like I said, DBO's really got to get below 19, and now we're back up to almost 22 today. So, not quite the fears of a couple of weeks ago when we saw those spike in interest rates and oil prices and everything else, but it's not getting better. And I think as the longer that this drags on, it's just a little more of a wait, or it just kind of makes when there is a turn, there will be a turn in this tech cycle. We don't know when it's going to be. It can continue to keep going, and we're watching that. And I talked about, stocks like Oracle or DRAM or even SoftBank. These are kind of more of the leverage plays of AI. They're all up huge today. So the market is still, very much like, hey, it's very much risk on. But when those turn, and you have these other weights like higher interest rates and oil, the hangover can be quite, you're at the party now. It's great. But the hangover can be a little bit, hard to handle. So you want to be just aware of that, not get too overzealous, and just kind of watch your portfolio really closely at these levels.
Oil is up, and gold and silver. Gold and silver are up a little bit, but interest rates were down. Everything was great last week. I mean, we saw the market take off. Interest rates, the 10-year went down from 4.56 to 4.45, which was that's a good sign, But today we're right back up again. But we're not above. We'll take a look at the charts a little bit later on. But we're not above the 50-day. We came and touched it, fell back today. So we'll look at some of the charts where they did go up, but it didn't break resistance. So we'll see what all of this means in the next couple of days.
One, just going back to high yield versus AGG. So AGG was up 0.38, 0.83. High yield is up 0.55. So once again, regular bonds outperforming high yield bonds, which can be a little bit of concern. But once again, if high yield bonds are still trending up, don't need to worry about it. It's all good. Still mean the risk is still on. It just means that that you had an opportunity to buy some high quality bonds there when the rates were higher. Now that they come back down, you're seeing a little bit of bump in the prices of just quality bonds. So that's great to see.
Interest rates were down, that's why the bonds were up, and you've talked about that for the last month.
Well, I just think it's a good, if I'm getting paid 5-6% in something that is not only going to pay me 5 or 6%, but it's also going to act as a hedge. If you want to play in the go-go stuff, go buy the go-go stuff, but maybe buy some other bonds too. You can play it both ways if you want all the AI stuff, but barbell it with some bonds, and then that way you're still remaining balanced. Where if the AI bet doesn't work out, your bonds are going to hold up well. You have some capital to reinvest when they pull back, and if AI works out, then so be it. You got a lot of money, and you can continue to slowly but surely rein that back in or take those profits off the table. As you always said, no one's gone broke taking a profit. So that's kind of what I would be looking at, because those really, in my opinion, are kind of the only two games in town.
Right now.
If you look at stocks, general stocks right now, if you look at the breadth of the stock market through the first 5 months, I think there's only 20 stocks making new highs.
Right.
20 out of the S&P 500, just 20. And so that tells you 480 are just kind of doing okay. They're not making all-time highs like the indices. So when you see that lack of breadth, it's just not the sign of an incredibly healthy market. Doesn't mean it can't broaden out over time and can then continue from here, but it just means things are getting a little bit at the sharp end of the point, and so you just don't want to necessarily sit on that point at this juncture.
Looking at this is the suppliers in blue. They're going, you can see they're going straight up. They're just taken off to the upside. While customers of AI are gone up, but not dramatically. They're sort of going
This is of NVIDIA. So you can look at like the top suppliers to NVIDIA. So it's like all the people that help NVIDIA make what they do. And then if you look at like the orange is basically Magnificent Seven. So we've kind of seen them not do as well. A lot of the customers, you see even Microsoft is down so far year to date. Amazon's doing okay. So, these much smaller kind of infrastructure type stocks, industrial type stocks, there's still technology, but various industrial supplier type stocks have done very well. And it's just on the back of just all this, unsatiable demand for AI data centers. So
that's what it is, the builders and all of that. Consumer confidence down again. New home sales down. Consumer confidence that's what's surprising a lot of people. It is at a low level, but people, especially who are spending, have a lot of money because they're in the stock market, they're in real estate, and they've done very, very well. So it's the K-shaped economy.
Yep.
And they're doing well, they're spending, but people at the lower end of the economic ladder are getting squeezed because of grocery prices, oil prices, gas prices. People who have money, to them, yes, $1 a gallon is much more to pay, but it's not going to affect their lifestyle. If they got to pay a little bit more for tomatoes, they're fine. But people who have to measure this stuff, who want to make sure that if I put more gas in my car, then I have to take it away from somewhere else.
Yeah.
Those people are definitely.
Well, and I think that's what's making this market a little bit nervousness in terms of its impact on the economy. Now, typically the stock market and the economy, they go hand in hand, right? It's earnings and it's population growth, there's a lot of things. But also what drives a lot of the stock market is the multiples, right? And the multiples, or at least the expectations on earnings, are really high. So the multiples haven't even expanded a lot. But this is all happening in a very kind of niche part of the market. It's not happening broad-based. We're not seeing, all of this, happen across the board. So I think the stock market, it's going to be interesting when we ultimately do see the tide turn. Once again, we don't know. We're not calling for that. We don't know when that's going to be. It seems like things are still very much on the upside here going forward. But when that does turn, that could have some knock-on effects for the economy. Because then people start to, that have all this money, they say, oh, well, I don't have this money anymore. It just disappeared. Stock market went down 10%. and then that could start a little bit of a vicious cycle. So we're not there yet. Everything's still looking good. All the indicators are still pointing positive, but you just need to enjoy it and continue to watch it vigilantly.
A lot of data coming out this week. Basically, it'll be the unemployment data that comes out on Friday. That's going to be the big one, and we'll have to wait and see how it comes out. Expected no change, no big change in it. The unemployment rate's still at 4.3%. So steady as she goes. That's really what it is. Market's doing well. You've got to make sure you're allocated properly and don't get out of balance. That's all I can say to you right now. Looking at the technicals, market just broke out, continues to go higher on the dailies, broke out above this resistance area. Now the next target becomes somewhere around 8,100, 88,050, and we're 7,600 today. So we've got another 400 points. That's the way it looks now, and technically there. Weeklies are something different, but they have broken out. This was the initial target, the Fibonacci target, the projection for the market was right here. Now that we've gone through it, it's called an extension, and the extension comes up to here. That's about 8,200. Same thing on the weekly. So we'll have to wait and see. Charts look good. Everything looks good there. NASDAQ, again, looking great, broke out. We've got a third wave up on the dailies, just like we have on the S&P. Somewhere we're going to get a fourth wave pullback before we take off to the fifth wave. So that looks good. We're looking for a fifth wave extension for the NASDAQ. Somewhere around 29,000 is the weekly target. Now that we've broken out above this resistance, we're 27,000 today. So 29,000 plus or minus is the fifth wave target on the upside.
Looks great.
Yeah, enjoy it. Small caps are slightly different, but again, breaking out, extension on the fifth wave, somewhere around here, 146, we're 138. Chart looks good. A weekly chart for the international index looks good. Third wave up, could get a fourth wave pullback somewhere and then a fifth wave up. So everything looks really good on the charts, but when things really look good, I get worried. When everybody's not worried, that's when I get worried.
Yeah, agreed.
That's the way I look at it.
I'm not happy when the market's down, of course, because clients and everything, it's through a difficult time. But I know this is actually an opportunity. I'm not seeing a lot of opportunity. I know everyone's excited, but given where the valuations are, typically it's great. But if I'm a retiree, taking money out, do that remodel in the home. Go do the kitchen and do that bathroom because you got it because of AI infrastructure spending right now. I don't know how that long that's going to last, but if you do that, you invest in your property, you're going to have that for the rest of your life that you get to enjoy. Easy come, easy go. So that's kind of where I think but maybe this is fundamentally something very different, right? With AI, agentic AI, and where it's headed in terms of being able to create just unbelievable amount of scale that we didn't even think was possible because we're removing the human element, right? And the computers and everything can start to do it on its own. I personally believe that at some point there's going to be some blowback to that, right? We talked about potentially antitrust or the Fed, right? We start to see higher inflation. The Fed, by the way, the new chairman's going to be first meeting's going to be when June 17th. So we still have a couple weeks till that, but we'll see. I think those are going to be the two things that can really put an end to the AI investment kind of bubble or investment cycle. I don't want to call it necessarily a bubble, but those things maybe they're not on the horizon. So then enjoy it while it continues to go.
That's it. Oil took off to the upside, broke down here, gap down. Today it's right here at the 20-day moving average. 2192 is that number. We closed at 2177 today. So right there at the 20 days. So we came down, came back up. The question is this an island bottom? But there's a lot of gaps up here. They just gap oil.
It's all over the place. Yeah.
You see all these gaps all
over.
Well,
it's just kind of trading on the headlines, but I think you have to look at it almost seems like now we're establishing a higher range. If the Strait of Hormuz is going to be closed, we're looking at now the previous range was kind of in between, I would say 2150 and 19, right
here.
Yeah, that range right there. But now it seems like we're maybe in a higher range between 24 in like 21. So the chart has just kind of shifted higher. I think we kind of bounce around in this new range. If it's, if the reality is that the strait's going to be closed for foreseeable future, I mean, that's a big. We showed some charts, a couple of at the inception of the Strait of Hormuz situation and Iranian attacks. Was that, is this a geopolitical event or is this an energy shock?
And we showed the difference between an energy shock, how long that lasted, what kind of impact it had on the stock market, while a geopolitical event, which goes down, comes
right back up,
and it's over.
But it's starting to feel like an energy shock to me.
It is. I mean, this is long lasting. Even if they open the Gulf of the Straits of Hormuz tomorrow, it'll take a long time to get production back up.
Yeah, 2027.
That's what they're saying. That it could take 6 months at least to get. But I think just the anticipation of that oil is going to come to market, and then the rest of we're producing a lot of oil and so on. So that could really put downward pressure on the market in anticipation of that oil. But it's got to get open. That's the question. And when is it going? It remains closed for another 2 or 3 months. We've got a problem because right now we're using a lot of the energy reserves that countries had put away in case of emergencies. But that will only last so long.
Correct.
And after that, we've got problems.
Yeah, and you'll start to see things. I think I don't think it's anything going to be rather dramatic, I would say, per se, but it's just slowly eroding that margin of safety that these central banks, and then when you start putting more and more pressure on the hull, then the bolts start to pop off one at a time. And I'm just saying the pressure's still being applied, but you're not quite seeing anything, necessarily catastrophic in terms of parts coming off the boat. But the longer these things stay here, I think the more and more pressure it's ultimately going to have. And then once again, you can still have the AI trade. It's not really tied to oil.
Right.
It's not really tied to a lot of these things. It's just kind of tied to the tech companies and earnings and constraints around a lot of other different things. But when it comes to when that cycle necessarily turns, and then you have this also happening at the same time, not a great combination. So let's again, I don't love the ingredients we have working with here, but I do love the fact that we're making all-time highs. So we'll just continue to enjoy it while it lasts.
Now, oil, again, this is a weekly chart of oil. You can see it hit a high. Last 2 weeks it was down, but today it's come back up. So we'll see exactly where we end up. But it looks like if it starts to break out above this range, we had this range that we had made right here to right here. We're setting up a new range somewhere around here to here. If we break out above this, that could be a problem.
Yeah, I mean, I think even where we're at right now is a problem.
Clearly,
if it goes higher, then it's much worse. The higher oil goes, the faster it goes, then that can itself be the catalyst for, like we saw a little bit when we saw interest rates rise, right? And all of that. And so you'll see if oil prices continue to go much higher, interest rates are going to rise, and then that brings forward the timetable for the Fed to put a kibosh on the party because they're going to have to come in, start raising rates. And with all of these, any stock that is, you're seeing stocks with 200, 250, SpaceX, the PE is going to be to the moon. When you start to see interest rates rise, just like we saw in 2022, all those companies, came back down to earth pretty quickly. So, all of these things are kind of tied. I would say it's not to the point of clearly having a point to any breaking point. But there is some kind of anxiety there that if those things go higher, and then it all feeds back into this chart, the 10-year Treasury.
Yeah, this looks like a nice island top right here that we left, right here, that we gapped up and gapped down. Let's see this gap right here and this gap right here. So that looks good. But today we came back up on rates, not a lot.
What if we fill that gap? So what if it goes back to 4?
That means this whole thing, it doesn't look like a top then.
Yeah.
It negates this downside.
So then that low we made, around 4.5, we get it back up to not 4.5, 4.55 on the 10-year.
Right.
That could, maybe we have some higher to go.
So yeah, if we get above 4.65 or 4.7 where we were as a high 4 weeks ago.
Yeah, I'm still just not worried a lot about inflation. I know there's a lot of talk about it. We talked about
that's
rents.
Going to be the question. Oil going up, is that going to be inflationary? But if oil goes up, it's in the long term deflationary because it slows down the economy.
Yeah,
And people don't buy stuff. They can't afford to buy everything else.
well, and a key component of inflation is housing. So I was looking at some of the housing numbers this week. Housing's only gone up 1.5% prices nationwide over the last year. So it's not keeping up with inflation. Clearly.
It's starting to come down, as a matter of fact, in some areas.
And so then because of that, because there's a lack of housing, renters are feeling okay. Their rents are kind of remaining stable when they go for their yearly kind of update, and it didn't increase or stays the same. So, and a lot of that I think has to do also with the immigration policy. Yeah, I was reading a piece by First Trust, and they were talking about now that we have zero net immigration, there's just less demand for housing. And so that's kind of opened up a little bit more. It's kind of released the valve on, these housing prices just continuing to go up. And so, that's, I think, helping in the sense that is curtailing a little bit of the inflationary pressure in the economy. And if, both housing, oil, is very volatile, but it's really housing that's going to really drive this chart long term. And as long as housing's kind of remaining relatively stuck where it is today, then I don't think we see that huge run up unless the Fed just comes out and starts pumping this full of money, which would be maybe what the administration would want. I don't know why, because I think that would sow the seeds of eventually a big correction. But Kevin Warsh always talked about curtailing the Fed, and all of this easy money printing, all of this quantitative easing is unnecessary. Well, we're going to see how much he really believes in that conviction here in the next couple of months. As we
You'll have to say he's in a tight spot.
Yeah,
it's going to be very interesting what he says at his first meeting. Gold continues to drift lower, not going anywhere really. I think gold is just coming, sort of drifting down, stuck between the 50-day and the 200-day. If it gets below 4,000 gold, I think then this was the top in the gold market, which I thought it was at that time. And then we sort of drift down to here, somewhere around 3,700, right into this range, which is about 3,500 to.
Yeah, it seems like just the general trend of central banks acquiring gold has kind of shifted more to neutral. I wouldn't say it's quite negative in terms of overall. And so then that's, I think, really shifted the gold chart into kind of more of a neutral pattern here, not necessarily bullish or bearish. Yeah.
Here's your chart for relative strength. Continues to look good.
Yeah, started to break down a little bit last week. Like I said, you start to see that relative strength chart starting to come down. However, high yield is still trending up. So even though relative strength, you're more of your conservative bonds, more investment grade treasuries, et cetera, all of that's in the aggregate index that's tracked by an ETF called AGG. It's kind of the big bond benchmark out there. As long as high yield is still, it's not going up as much as AGG, but as long as it's still going up, everything still looks positive. Once again, this is why we're putting this chart in the weekly update. What we worry about is AGG going up and HYG going down. That's the risk-off signal from the bond market saying, we really, we're starting to worry about growth. And if we're going to worry about growth, then we're going to potentially worry about earnings. If we're going to worry about earnings, then we're going to worry about stock prices. So we'll continue to watch all of that. But I think this has been, still very much telling us everything is still in a very positive orientation.
Don't forget to click on the subscribe button, quick note, and you can get these updates and all the other information. It's all there. If you need help with your portfolio, if you're getting unbalanced, if you're getting too excited about your portfolio, if you're going to say, oh yes, I've hit the home run, give us a call. Invest@compact.com, or just go to 800-388-9700. Those are thoughts, those are observations. We'll be off.
Recording note, yep.
Yeah, for a couple of weeks. We're going to be taking a summer break.
You're taking some break. I'll still be here in the office, so if you'd like to give us a call and work through the summer. But hopefully everyone's enjoying. It's a wonderful kind of time of the year if you're fortunate enough to have some new graduates and just really celebrate all of those successes. And hopefully the weather's getting better for everyone as we head in here to early summer. And so we'll be off for the next 2 weeks. I think we'll be coming back on June 22nd. Well, hopefully the market hangs in there for the next couple of weeks. I don't know. Sometimes when you go on vacation, I've seen this before, things tend to turn, and then a lot of people give us a call and say, hey, Mo, what's going on? But he's he's enjoying life. But I'll be here, and if necessary, we'll
I'll
do
be
it
here
next
also,
week.
folks. If you need to get in touch with me, I'm sure Javaid will be more than
Yeah.
happy to answer any questions about your portfolios. Feel free to call us. Those are our thoughts. Those are observations for this week. We will be back with you in a couple of weeks. Until then, good
Good
trading.
trading.
This presentation contains the current views and opinions of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.